video, I'll be showing you how to catch 100 to 200 pips on GBPJPY daily. It's a very simple and straightforward strategy, and I'll be taking you to the chart shortly. But before I do that, don't forget to like, subscribe, and turn on your notification button so that you can get videos just like this whenever we drop it. Alright, welcome back everybody. So I'm going to take you straight into the chart right now, and I will be explaining this simple strategy that I use to take 100 to 200 pips on GBPJPY consistently. Okay, so let's dive straight into it. But before we go into the strategy, I would like to explain some basic things about the forex that you need to understand. So you see, in the forex market makes two basic type of moves. So it is either market is trending or market is ranging. So these are the two basic types of moves that market makes consistently in, right? So now, for a trending market means a market that has a direction. So whenever you look at a trending market, you can clearly see that it is either going up or down, right? It is moving upward or downward, right? Let me give you an instance. Now, if you stumble on a market like this, now looking at this market, it is clear that it is going up and down. Yes, correct. But then the overall sentiment of this kind of market is to the upside. So for when you see this, you can see that this is a trending market, right? Now, reverse is the case. Whenever you see a market making up and down, but it is going towards the downside, you can clearly see that the overall sentiment of this is downtrend. So you call it a downtrend, right? So it is still going down and up, but then this overall market is going downward. So this is a downtrend and this is an uptrend. That is for a trending market, right? Now, another thing you need to understand that whenever market is trending, it makes two types of move again. Now, it makes the impulsive move and retracement. It makes the impulsive move and the retracement move, right? Now, what is the impulsive move? The impulsive move is a move in the direction of the trend. For instance, when market is moving upward, the impulsive move is that move to the upside, right? If it's an uptrend. Now, retracement is a move against the impulsive move. So when the impulsive move is going upward, retracement is the move that comes downward in an uptrend. Now, for a downtrend, the impulsive move is a move that moves downward. Is the move downward, whereby the retracement is the move upward in a downtrend. So you need to understand that. Now, when market is trending, the impulsive move is always longer than the retracement. The retracement is just a correction of what is happening on the impulsive move. Okay, so that is when market is trending. You need to really understand this. I believe that whenever you see this kind of move, for example, look at the chart over here. You can see that over here market is doing a downtrend, and then it corrected itself and it started moving to the upside, right? So that is that for a trending market. Now, the second type of move that the market makes is the range market. Now, the ranging market is a market with no direction. It's not going anywhere. It is just moving horizontally. So whenever you stumble on a market that looks like this, now looking at this kind of market, it is obvious that this market does not have any particular direction. The overall sentiment is not up or down. It is just moving sideways. So we call it an horizontal market. It is a market that is consolidating, waiting for the move to bust out, right, of the range. Now, this market moves in a range. So you can see that it's finding it difficult to break this upper range, and it is also finding it difficult to break this lower range. So whenever you see a market like this, that it is respecting a level up there, it is also respecting a level down there, that is a ranging market. It's not going anywhere, it's just moving horizontally, right? Now, an important thing you need to know, according to statistics, in forex world, market does not trend every time, and market does not range every time. So market trends 30% of the time. Market only trends 30% of the time, and market ranges for a whole 70% of the time. So whenever market is ranging, market does it for like 70% of the time. It is just moving sideways. Then there will be something that will just prepare market to shoot to the upside or downside and make it trend for just 30% of the time, right? So you need to understand this. I mean, this kind of knowledge is important for you if you want to be a profitable trader. If you want to be a consistent and profitable trader, you need to understand overall market sentiment. You need to be able to realize when market is trading, which is just 30% of the time, and when market is ranging, then you apply your strategy as the market dictates. So for example, you have a trend following strategy, you don't want to use it when market is ranging. And if you have a ranging strategy, you don't want to use it when market is trading, you just find yourself in loss every time because you don't understand the overall market sentiment. It is important for you to differentiate whenever market is ranging and whenever market is trending. This strategy that I use to take this kind of move on GBPJPY consistently is a trending strategy, right? You don't want to apply it whenever market is ranging. Okay, so take note of that. So let me take you to the real-time chart. Now, looking at this market, we can see clearly that from this point, market is trending downward. And why is it trending downward? Because it is making series of lows. Now, when market is trending downward, it makes lower lows and lower highs. I will explain that shortly. Now, at this point, market pushed downward, right, to form a new low. Okay, so we tag this place as our lower low. Okay, and at some point it moved upward again to make the retracement because the overall sentiment is downward. Now there is a move upward that is against the trend, so it forms what? That's why it's called the retracement. So it forms the what? The lower high. Then it moved downward again to form the lower low over here, pushed upward again to form the lower high, push downward again to form the lower low, the lower high. Now it is the lower high. Now it is the lower high because market is finding it difficult to break the previous lower high to the upside. So it is forming a new lower high and it is forming a new lower low as it keeps going downward. Now over here, there was a push downward here too, to form the lower low, and then it's pushed upward here to form the lower high, right? Now something happened. Market pushed to the downside again to form another lower low, to form a new low below it. Now, me looking at this, market formed a new lower low, lower high, and then it pushed downward to form what? Your lower low. A new lower low was formed here. Now, ideally, because market, the overall sentiment is towards the downside, you are expecting market to form a new lower high so that the move downward can continue. But something happened. Market decided to break away from the previous lower high. Can you see? At this point, market broke this lower high to the upside. Now, what does that mean? It means that a new lower high was not formed. But because market has broken the previous lower high, that means market has formed what we call a new high. So now it is no longer referred to as a lower high, it is now called a higher high because the sentiment is changing towards the upside. For market to break the previous lower high to form a new high, it is no longer a lower high, it is referred to as the higher high. Now the higher high is telling you something, that the momentum of the sellers has reduced and there is going to be a possible move to the upside now. Now remember, from the basic forex understanding, you want to buy when you know market will go up and you want to sell when you know market will go down. Market has been going down. This will not be a perfect place for you to sell because you are seeing signs that market will start going up, and the sign is when a new higher high is being formed. Now guys, this is the basic market structure. This strategy is taken from the basic market structure move, right? So you don't have to complicate your strategy in any way. Just identify your highs and lows, your trending market or ranging market, and you will keep making consistent profit from the market. It is as simple as that. Now back to the chart. Market has formed a new higher high. That is giving me a sentiment that okay, this market is about to start pushing to the upside. Now what I do is I wait for price to push back to that lower high, because my lower high point has now turned to my resistance that was broken to form a support. So my previous lower high is now my resistance that has now turned support. Ideally, when market broke out of this lower high and pushed to the upside to form a new higher high, I don't want to buy when market is going up. I want to buy after a retracement and setting. So right here, I will just be waiting for the retracement back to my lower high to pick a very clean entry from there, right? And then after market broke to the upside to form higher high, then there was a retracement to my lower high, right? And after that retracement setting, the next thing I'm going to be looking out for is candlestick pattern. It is as simple as that. I'm just going to be looking for candlestick pattern on this level, which is now my support. And ideally, you believe from your simple price action, you believe that price wants to push to the upside from a support and price wants to push to the downside from a resistance. So looking at this lower high now, it is now my resistance broken to turn to a support. So I'm waiting for candlestick patterns that would form on that level and take my market to the upside. So immediately I spot a candlestick pattern, and right on this chart I can spot a bullish engulfing candlestick pattern. This is a bullish engulfing candlestick pattern. You can see the bearish candle and then the bullish candle. For those that don't understand candlestick pattern, I'm still going to be doing a series, a video talking about the simple candlestick patterns that I use for my basic entry. So make sure you follow and subscribe so that you don't miss that video, okay? Now, looking at this market, a bullish engulfing pattern has formed. So what I'm just going to be doing is position myself at the close of the bullish candle and putting my stop loss below the low of the candle. Now, this is about 30 pips. 30 pips stop loss. And because statistics is what is important in the forex world, you want to be concerned about your risk to reward. That is what will give you an edge in the forex market, right? So I'm going to be targeting, let's say, my 100, or let me just use my maybe 120 pips. I'm going to be targeting 120 pips. Now this is giving me a risk to reward of 1 to 4. That means if I'm risking 1% of my capital, I have a tendency of making 4% on this one trade. And if I'm risking 2%, I have a tendency of making 8% of my capital on just one trade. And as you can see, at the close of that bullish engulfing pattern, there was a little consolidation, and then eventually market shot up to the upside to hit my take profit. My take profit of 120 pips. Now, can you see how simple this was? This was taken from my simple understanding of market structure and price action, right? Market was trending downward, forming series of lows. Then I discovered that the low was broken to form a new high. And immediately that high was formed, I waited for a retracement back to my support level. And on that support level, what did I do? I looked for a simple candlestick formation, which is candlestick pattern, which is my bullish engulfing pattern, positioned my order at the close of the bullish engulfing pattern, put my stop loss below the low of the engulfing pattern, and then I targeted 1 to 4, and boom, this was straight to profit, 120 pips. You can keep applying this on your chart consistently, daily, and you can keep making that money. Now, this is not as easy as it looks. It requires patience. It requires you to practice actively, understand how the market moves. Like I said previously, you want to be sure of the kind of market sentiment that is running before you even get into the market, because that is what is going to affect your buyers. You want to be sure if market is trending or market is ranging. If market is trending, you can apply this simple market structure strategy and keep making your profits. And if market is ranging, there are so many other strategies that you are going to apply, which I'm still going to be showing you. So guys, if you enjoyed this and you've learned something from this simple strategy, don't forget to like, subscribe, and turn on your notification bell so that whenever I drop a similar video like this, you are notified and you don't miss out on the highly profitable strategies I'll be dropping in this channel. See you guys in the next one. Have fun.